Our panel's ready to talk all about the economic data that's pouring in and what the Fed may or may not do next. John Lekas is with us, President, Senior Portfolio Manager of Leader Capital, and Peter Tchir, Head of Macro Strategy at Academy Securities. Thank you both for being with us. Peter, how are you feeling in these days?
Not too bad. It's, I feel like we're balancing right now the tariffs that are coming in a little bit higher than I think maybe people initially thought. We're not seeing any impact yet. I think we will. On the other hand, we've really seen the administration turn to what we've been calling national production for national security, where we need to make sure we're making the things that we need to be safe and secure. That goes from chips to pharma. Just last week, the president talked a lot about making sure we do everything for AI, including getting the electricity the AI and data centers are going to need. So I think if we head down that focus, less deregulation, incorporate some of the benefits of the big, beautiful bill, like accelerated depreciation, we can move along. I'm worried the tariffs get in the way a little bit.
Okay. Sounds mostly optimistic. John, what say you?
I think the tariffs are going to end up kind of being a non-event. And if you look at some of the estimates, from the administration, $100 to $200 billion. I think the real story here is the dollar. And I think the dollar goes lower. That means equity markets go higher and interest rates go higher, and the Fed is not going to cut. As a matter of fact, if the dollar moves down another 10%, they might actually be in a position to have to raise rates on the short end. So the good news on that is, we have a pretty good sized deficit, and if you move that dollar down 20% and you're refinancing 15 trillion a year, I mean, that's a couple $1 trillion savings on the international side. That's what I think this administration is all about. That's what the saber rattling's about. Countries like Canada selling dollars. I mean, that really plays into this administration's hand in terms of refinancing debt, increasing exports, and increasing prices. So we think that's inflationary, yes, but that's good for equity markets. Not so good if you're in the long bond.
It's funny that you talk about the tariffs not being really a big deal at this point, almost somewhat of a non-event. As we've become more used to them, we're starting to see a lot of 15%, not 45%, et cetera. And Peter, I had one guest who said that the tariffs he was leaving behind, he was so focused on some of the trends, AI revolution, manufacturing revival. He was feeling much more positive. And so now, what do you think about the July jobs report? How consumer sentiment is shaping up. Peter?
I'm still a little bit mixed. I think the jobs data the past few months has overstated the health of the economy. I am particularly concerned when I see youth unemployment, fresh college grad unemployment. Those are the jobs that may be getting replaced by AI. We'll see this where all comes out. But I think even with these, 15%, yes, there's some certainty. Tariffs are going to take their toll. I think it's been hitting small and mid-sized businesses much faster than large companies. So I think we're going to see a continuing weakening in that. And with that, I think we'll see a bit less consumer consumption. People got ahead of the tariffs, both large corporations, but individuals bought things. So we'll see what the steady state of the economy looks like. I think it's slightly weaker than what we've been getting. I think it's going to force the Fed's hand to actually cut as early as September. And I think we're probably going to get 3 cuts this year because the job data is going to be wobbly enough that they have to react to that and they can ignore inflationary pressures.
So different. So 3 cuts are possible, in your opinion, Peter. John, you were so concerned about the weaker U.S. dollar, you even sort of alluded towards a rate hike. What do you think about the jobs picture and consumer sentiment and how those will drive things, John?
Yeah, I think, look, if you're going to stay with the numbers, then stay with the numbers. The jobs number went from 4.3 down to 4.2. I think that number stays at 4.2. Frankly. And again, back to our theme, which really is a lower dollar, is really the story here. That's inflationary, and inflationary always moves prices up. And so, we think if that happens, the stock market's going to be fine. Credit spreads remain extremely tight. They're 150 on the investment grade side. They're 350 on the high yield side. That's very doable. Mortgage rates at 6.5. Yeah, the housing market's going to get a little soft here. It has been, but look, overall, with credit spreads where they are, unemployment going down, not up. the dollar going down further, that's all good news for companies and price increases. So, we think everything is in pretty darn good shape, quite frankly.
So that's pretty good news. Peter, are you worried about inflation?
I'm actually not as worried about inflation. One is, yes, I think the longer term trend is dollar lower. It's become a very crowded trade. For a contrarian, I kind of see the potential for a little bit of a bounce. We saw a little bit of that in the past 2 days. I think that inflation will creep in. When I look at these tariffs, I think it's 10 to 15%. Some of that will get passed on to consumers, but it's going to get passed on over the course of a year or more. So I think there's some upward pressure on inflation. I think against that, we actually do this. I'm more worried about the jobs, obviously, on the other side. So I think that pushes it. And listen, right now, with the tariff revenue has been interesting, right? We're getting about 30 billion a month for the past 2 months in tariff revenue. That's up about 20 some odd billion from the baseline. So 40 billion, 50 billion we've had in tariffs so far, that helps against the annual deficit. And it's a drop in the bucket for inflation. But as that number keeps rolling in and piling in, it will become a bigger inflationary pressure. It will slow companies either as they have to figure out how they address profit margins. Again, if the dollar keeps weakening, some of that goes away. If the dollar just stabilizes, I think there's some risk. And so far, we've had kind of the best of all worlds. If you're the administration, the benefits of tariffs are hitting right away. The problems that might show up have not shown up yet. They should not be expected to show up. So I think as those dribble in, that's going to give the Fed the reason, hey, we might as well cut. There's not big inflationary pressures. There's subtle inflation pressures, but we need to keep this job market on track.
Yeah, and I noticed in your notes, too, you said expecting some mild equity weakness and bond strength as jobs data hits this week. So we have a lot to digest and take in. John, Peter, thank you both so much. We'll have to do this conversation again and again in the next 6 to 12 months. Thank you both so much, John Lekas and Peter Tchir. Thank you.